Hey everyone, welcome to Undervalued. So today we're looking at STNE. This is a high growth company in the payments area, and it's headquartered in Brazil. They are basically primed to basically take up the opportunity of this growing economy, where payments is needed more and more as the economy basically just develops in that area. So you can see with STNE, if they execute well, they can do very well. Like the share price in the middle of last year was like close to $70. Now it's $9.35. So it's fallen a lot. Though it's also fallen because they didn't execute too well last year. They kind of misspent their capital as well. They brought shares at They did a share repurchase program with $199 million, purchasing 3.5 million shares at $55.40 per share, which is insane. Like, imagine them wasting that much money, because you look at the share price now, in hindsight of course, it's just like a terrible use of money to repurchase their own shares. But if they thought their shares were underpriced at $55, think about it right now, it's very, very underpriced. So it kind of means definitely a very good long-term kind of company, because they are growing at a very good rate. So if we look at their fourth quarter results, which was released in March, they had 87% growth, which is pretty good. They report in Brazilian real, so when you see that 1.9 billion, basically divide that by 5, because 1 Brazilian real is about 20 US cents, so hence why you divide it by 5, and which gives them just less than 400 million in revenue for the fourth quarter, which is pretty good. They added 378,000 clients in the fourth quarter, which is very, very impressive, reaching 101.8 million active clients. So overall, you're dealing with a company that is growing very quick, on some pretty decent revenues as well. So you do have the company saying 2021 was an unsatisfying year for STNE. We executed well in some areas, but faced challenges in others. We believe our market opportunity is huge and merits an aggressive approach, but we tried to do too much last year and did not execute as well as we would have liked. So basically that just sums up how they feel themselves, and it's good that management kind of recognizes that, and that they probably have to look at their mistakes and then try to do a bit better. A good example was our execution challenges were exacerbated by the problems of the national registry system, which we did not expect and therefore were not well prepared for. So in a sense, they didn't quite understand the system and the challenges that it would provide, and basically that they learned from this, so that won't be a problem now for this year basically, and they can just basically continue doing what they will do. And also in prepayments, our focus on growth delayed repricing of our solutions, while interest rates in Brazil was rising sharply throughout the year. So that's also impacted profitability as well, because they weren't able to change their pricing, whereas things got more expensive. So you get the whole idea. The company's learnt, which makes it a better company overall. And the fact that they had so many problems and they still grew 87% for the fourth quarter shows you basically that you're dealing with a company that is in a very, very good area to basically grow in, because Brazil is a developing economy that kind of needs this kind of technology, and basically it's in high demand, and as long as they can execute well, they are primed to take advantage of this opportunity. So yeah, like you think about where they could basically be heading next. If we look at their forecast, the forecast is pretty good. Like, where are we? I think, oh, there we go. So the outlook for the first quarter for 2022, which they should probably be reporting quite soon. Okay, so they report around the end of this month or the start of next month. So there's no certainty yet, but I think it should be a pretty good quarter. Like, total revenue and income expected is 1.85 to 1.9 billion real, so roughly around less than 400 million, and that will be 113% to 119% growth, which is pretty amazing. Though if they take the acquisitions out, the original company grew about 67 to 72%. So the acquisitions have helped them grow, kind of boost up the revenues as well. And in terms of adjusted pre-tax income, it's expected to be about 140 million real, compared to 17 million real last year. So you can see this year they're performing a lot better than last year. Last year there was not much profitability. This year it looks pretty good. So if we're probably looking about 28 million profit for the first quarter, pre-tax though. So in a sense, like if which is pretty good, like for a company that's focused more on growth and profitability. But this year they said they're going to focus more on profitability, so you can kind of expect the profits to continue to pile up. So basically, pre-tax, these guys could be doing like 100 million in profit, assuming it's similar to the first quarter. But likely it's going to be, I think as they grow the company as well, and the revenues are larger at the end of the third and fourth quarter, the profits are going to be larger in those areas too. So hence why you're basically buying a company that's at 2.8 billion, and it's going to be generating a very, very healthy profit as well, while growing at a very high speed. So then it kind of looks like a really, really good opportunity and a really, really good type of company to be in. So overall, like, I think I'm pretty happy with like those financials. In that sense, like, definitely encourage you to come to the StoneCo website, go to the investor section and have a look yourself. Like in terms of cash, they had I think some like a few $100 million in cash. Wasn't like a lot of cash. So overall, like I wouldn't say it was like hugely cash back, but they were a profitable company. They spent the money last year knowing that they would be a very profitable company going forward, so they weren't too worried around that. So that's kind of why I guess they spent quite a bit of money, and why they would blow $200 million buying these shares at $55 per share, which is like insane hindsight. That's just insanity. But basically it means it's a good opportunity for you to hop in at this kind of pricing for this kind of company, which is a pretty good company, which is primed to do very well as long as they can execute well. And I mean, it kind of shows, like, if last year they thought they didn't execute well and they still grew at 87%, 87%, then yeah, like, they're basically, if they perform well this year, who knows how well they will be performing. Though, as I did mention, they're focused on improved profitability for 2022 and continued growth. So you like, this is probably a perfect company for someone who can kind of take on a bit more risk, and it has a longer time frame, because firstly it's growing very quick and it's a very profitable company, so you don't have to worry about them kind of needing to raise money in the future. And basically, unless they want to have another acquisition, like, that's the only reason I would see them raising money, is because they want to acquire another company that's going to help them grow even quicker. Apart from that, like, it's selling at a very, very good price right now. If they execute well at the end of the year, I definitely see the pricing a lot higher than it is today. Which, like, out of many type of companies available, I think this is one of the very good ones out there, that basically it's a perfect market to be in, and they're also growing very quick, very dominant. They made acquisitions to help them basically in this cause, and I think it's just going to continue. And basically, you just have to buy and hold, and then just let it do its thing, because we're looking at a company that basically they're going to be doing about maybe 1.5 to 1.6 billion US dollars in revenue this year, based on how based on the fourth quarter, based on the first quarter, they look like they're doing about close to 400 million every quarter. Which kind of basically they're selling at less than 2 times revenue, which is extremely cheap for the type of growth we're seeing in this type of company. So hence why, you look at the metrics and it looks extremely good value. But let me know what your thoughts are. Maybe you think differently. Apart from that, if you got any questions, post below. Until next time, good luck investing, everyone.